Okay, you guys, our next topic is current liabilities. So let's first look at a definition there. I'll let you read that one, but I'll just give you my definition. A current liability would be a future debt or obligation that the company has the intent and ability to pay within 1 year. Now, the formal definition says within 1 year or operating cycle, whichever is longer, but we're typically dealing there with a year. And those would also be paid out of current assets or by creating additional current liabilities. So, for instance, if a company had an accounts payable that they were having trouble paying, but by the time it was due, they could take out a short-term loan with interest to pay off the accounts payable, and then they'd have the note to pay. So, with current liabilities, one type that we'll look at would be a short-term note payable. There we've borrowed from a lender and intend to pay it back within sometime less than a year. So a note payable is a formal written agreement to pay, which typically requires the borrower to pay interest. Notes payable can be current or long-term. Again, we're focusing on current, so the notes in this unit will mature within 1 year. Now, some terms associated with a note payable. We've got the face amount or face value. It's the amount initially borrowed. It's also called the principal balance of the note or principal balance on the loan. I'll use principal balance quite often. The interest rate is the annual rate of interest that will accrue or build up on the note. The maturity date is the day the note comes due or when it matures. And the maturity value is the amount due on the maturity date by the borrower to the lender. And that would include the face value or principal amount plus interest that is built up on the note over the term of the note. All right, so to calculate interest on a note, a lot of times people will think you just take the face amount or the principal balance and multiply by the interest rate. Well, you guys, that will work if the note is for exactly 1 year. But note here on our interest rate, it says the annual interest rate. Interest rates are always stated in annual terms unless it specifically says otherwise. So if the note was for exactly 1 year, you could take face amount times the interest rate and get the amount of interest due on the note at the maturity date. But a lot of times the note might be for 3 months, 6 months, any period of time less than a year. In that case, we would have to say the principal balance times the interest rate times the period of time covered by the note. So if it were a 3-month note, we could express the time as 3/12 or 3 months out of 12 months. Now you could abbreviate that PRT if that acronym helps you to remember it. So let's look at an example here of a note payable. And we're going to do some journal entries. So on March 1st, Parker Company borrowed $100,000 and signed a 12% 4-month note. Now they want us to record all the entries associated with the note. Well, on the day they took out the loan, they would now have more cash, right? So we'll debit cash. The asset here increased. Assets increase on the debit side. And we're going to credit notes payable. The liability also increased, and they increase on the credit side. So assets increased by $100,000 and liabilities increased by $100,000. And loans are typically thought of as a financing activity, you guys. Now in the note here it says notes can be current operating liabilities as well. So an operating activity is a possibility here. But you guys, for our purposes, we'll call borrowings financing activity. And when we pay it back, the principal part that we pay back would be considered cash going out for a financing activity. But interest paid on the note will always be an operating activity. Note here, interest is always operating. All right, now the maturity of the note, well, let's do a few calculations with it here. First, we had a $100,000 note at 12% interest. So 100,000 times 0.12. So the interest on the note would be $12,000 if it were for a full year. But this one, let's go back and take a look, was a 4-month note. So to get the amount of interest due after 4 months, we'll say the total interest for the year times 4 divided by 12. 4 months in the note, in the term of the note, divided by 12 months in the year. And that gives us $4,000. So there we go. $100,000 was our face amount. $12,000 would be the amount of interest due if the note were for a full year, but we know this one was only for 4 months. So we say our interest for a full year times 4 over 12, and that gives us our interest due at maturity. So let's go back and take a look at the journal entry now. All right, at the maturity of the note, the liability, that means what? We're going to pay the lender back. So the liability, notes payable, needs to come off the books. Liabilities, of course, decrease on the debit side. So the note will go on the books at the face amount or principal balance, and it comes off the books when it's paid off at the face amount or principal balance. Now we're going to debit interest expense from the borrower's point of view here. So we'll debit interest expense for the $4,000 of interest on the note. And then we're going to credit cash for $104,000, the amount required to pay off the note. Now the principal payment was a financing activity. The interest, like we mentioned before, is an operating activity. So what happened here? Interest expense increased our expenses by $4,000, which decreased net income by $4,000, and decreased stockholders' equity through retained earnings by $4,000. And then what? Assets decreased by $104,000, our credit to cash, and liabilities decreased by $100,000, our debit there to notes payable. And notice that balance is right. You got negative $104,000 on the right side of the accounting equation, and a negative $104,000 on the left side as well. Okay. All right, next let's take a look at the same example with a small difference here. The loan was taken out on November 1st, still $100,000 principal balance, 12% interest rate, and a 4-month note. But note the difference here, you guys. If it was borrowed on November 1st, and this business is using the calendar year as their fiscal year, then part of the interest is going to build up on the note in year 1, in November and December, and then the other half of the interest on the note would accrue or build up in January and February. So let's look at how that will change it. You know, any expense, any interest expense built up on the note by the financial statement date, December 31, should be recorded through an adjusting journal entry. So that's going to make this one slightly different. But when we take out the loan, no difference. You're going to see the same entry you saw previously, except it'll now be dated November 1st. But we debit cash for $100,000 and credit notes payable for $100,000. Increasing assets and increasing liabilities. And again, that's cash coming in from a financing activity. Now, at the end of the period, we want to make an adjusting journal entry to get the interest expense recorded in the proper period. The interest built up in November and December, the interest that built up over those 2 months represents an expense for the company and a debt for the company. It'll be a current liability as well because it's going to be due within 2 months of the financial statement date there. So what we want to know is, of this $4,000 total interest on the note, how much of it has accrued or built up by December 31st. Well, the loan was taken out on November 1st. December 31st would be 2 months later, right? So what we can do here, instead of at maturity, we could say interest due at 12/31. Well, that would be equal to total interest on the note times 2 over 12, right? For the 2 months, November and December. So it's easy to see here. That would be $2,000, right? Half of the interest built up in year 1. The other half will accrue in year 2. Okay, so what we'll do here on December 31, we're going to debit interest expense. That gets the expense on the books in the proper period. We haven't paid it yet. If we had, we'd credit cash. But instead, that creates a current liability for us, interest payable. So we debit interest expense for $2,000 and credit interest payable for $2,000. That gets the expense on the income statement in the proper period, and it shows that interest payable as one of our current liabilities on the balance sheet at year end. So what happened here? I think I'm going to move this down. There we go. Interest expense increased by $2,000, causing net income and stockholders' equity to decrease by $2,000. And then the liability interest payable increased by $2,000. All right, next, when the note matures, now this will be on March 1st. Well, at that point, the note payable of $100,000 needs to come off the books. So liability decreases on the debit side. Or a lot of times I think of it as it went on the books as a credit, so it has to come off the books as a debit. So we'll debit notes payable here for $100,000. It's been paid off. It's no longer a debt of the company. All right, now we're also going to wipe out this interest payable here when we repay the loan. So we'll debit interest payable to knock that liability out as well. Then for interest that built up in year 2, that would be the months of January and February. We'll debit interest expense. That gets that interest expense on the books in year 2. And year 2 was when it built up, right? It's for the months of January and February. And then we'll credit cash for the full 104. Now the purpose there, you guys, is to get the expense recorded in the proper period, right? So half the interest expense on this note accrued in year 1, while the other half accrued in year 2. That helps make sure our net income is correct on the income statement, right? If we did not record this $2,000 of interest in year 1, then we'd be overstating net income by $2,000. All right, let's keep moving here. Say one last thing to consider: if the note is expressed in months, you use the number of months held divided by 12, and we've done that already. If the note is expressed in days, you typically use the number of days held divided by 360. And I know that's not the number of days in a year, but like 30 over 360 or 60 over 360 reduces to a nice whole number. So your textbook will use 360 there. All right, we have looked at a month count. For the following note, we're going to calculate interest. We're going to use days instead of months. All right, so on March 15th, Parker Company borrowed $150,000 by signing a 90-day 8% note. Okay, so our interest calculation there would be the face amount or principal balance of $150,000 times our 8% rate times 90 divided by 360. And you come out there with $3,000. I hope that makes sense, you guys. You know, the 90 over 360 is essentially the same as 3 over 12, right? All right. Thanks a lot. And as always, please be in touch if I can help you.